Welcome to Foreclosure Prevention 1, brought to you by NHNLA. This is Section 1.1, Introduction to Foreclosure Prevention Counseling. In this section we're going to cover the evolution of the foreclosure crisis, the foreclosure process itself, and then later on in a different unit we're going to discuss who are the most important players. So just to give you an idea of what's happening nationally, these stats are from RealtyTrack in August. The number of properties in August receiving a foreclosure notice was 7% higher than the previous month and 9% lower than the same time last year. Nationwide, there are over 1 million properties in some stage of the foreclosure process. In the first quarter of 2014, we were at a 70-month low for foreclosure activity, so things have quieted down quite a bit. But there's still a lot of activity going on nationwide. To give you an idea of the current distributions of foreclosures, if you look at that pie chart there, about a third of properties are in some stage of pre-foreclosure, about 43% are at or nearing auction, and then about 22.5% are actually bank-owned properties. And then this graphic shows you the density of foreclosure filings. So a lot of activity in the Midwest, Southeast, and also out west. National average is 1 filing per 1,126 units. So despite overall decreases in the foreclosure rates nationwide in the first quarter, there were 29 states that showed increases in foreclosure auctions. So you can see a lot of states there. Utah up over 200%, Oregon and Connecticut up over 100%. Basically now banks are shifting resources towards clearing off their REO inventory now that some of their foreclosure filings have kind of slowed down. So to understand where we are now, we have to kind of look back a little bit to some of the causes of the foreclosure crisis. There's a great activity for you in this section, the YouTube video titled The Crisis of Credit Visualized. For those of you who are visual learners, that's a really good visual interpretation of the things that were going on in the mortgage market that helped to accelerate the foreclosure crisis itself. But some of the other causes were toxic loan products, so a lot of interest-only loans, no-doc loans, stated income loans, basically a lot of products that never should have been offered. Unaffordable adjustable rate mortgages, where people thought that there was a teaser rate where the payment looked affordable, and then there was a significant jump in their payment, and then it became unaffordable for them. There were home ownership scams, increased unemployment nationwide, increased household debt, and a decrease in household savings as well. This graph shows adjustable rate mortgage delinquencies from 1998 to 2011. As you can see, the subprime loans are a much larger percentage of the overall delinquencies, especially from 2006 to 2011. You see a really significant bump there. This chart shows you alternative mortgage originations, or subprime loan lending, as a share of the total market. If you look in that right column, that gives you an easy percentage to look at. 2004, 12.5% of the market share of mortgage products were these alternative mortgage originations. We see that get as high as almost a third by 2006. So a huge jump in the amount of these products that were being offered on the market. Now we're going to talk about understanding the foreclosure process itself. What is foreclosure? What are the prerequisites to a foreclosure being filed? And then the biggest difference, between judicial and non-judicial foreclosure states. So first, what is foreclosure? It's the process by which the home is sold without the consent of the homeowner to satisfy an unpaid debt. The most common one is a mortgage lien, where the borrower simply has defaulted on payments. Tax lien sales happen as well. Mechanics lien sales can also happen. Most of your clients obviously are going to have a mortgage lien issue. So the foreclosure process itself is governed by state law. There are also requirements in the note and mortgage in terms of what kind of notice has to be provided, what the obligations of the borrower and the lender are, those sorts of things. There are also guidelines established by the investor or owner of the loan, and then possibly the insurer of the loan as well. And we'll also talk, if you take Foreclosure Prevention 2, we'll talk even more in depth about some of the federal guidelines. So before a foreclosure sale can take place, the first thing that happens is a default. Basically, the borrower fails to make mortgage payments, right? Or they fail to keep up their taxes, fail to keep a proper insurance policy on the property. There are different reasons in the note and mortgage for which a lender can declare default. Usually there's also a requirement in the note and mortgage for the lender to send the borrower a notice of default and or acceleration. So what it basically says is we will provide a written notice to you in writing that you're in default prior to proceeding with any kind of foreclosure. Acceleration is the method by which the lender declares the entire balance of the loan due because of unpaid payments. Usually you'll see a notice of default and acceleration. They usually do it all in one letter, so keep an eye out for that paperwork. So types of foreclosure. There's a non-judicial process in some states. There's a judicial process in other states. Some states have strict foreclosure laws. Connecticut and Vermont have strict foreclosure. So non-judicial foreclosure, this is also called power of sale foreclosure. There's no court intervention to speak of. It's a very quick process. I've heard people say it can be as quick as 90 days. And the main parts of the process are this notice of default and acceleration, the notice of sale, and then the foreclosure sale or the trustee sale. Judicial foreclosure, you'll want to look at the chart on page 4 of your written materials for this section. There's a graph there that kind of shows you the timeline of from the missed payment all the way to up to the foreclosure sale. Typically it involves the filing of a mortgage complaint, then the service of the complaint on the borrower. Occasionally there's a hearing on the sufficiency of the evidence within the complaint, known as a summary judgment process. Then each state is going to have different rules about the possibilities of the borrower actually redeeming the property or buying the property out of the foreclosure process. My state, Indiana, and quite a few other judicial states, we don't have a redemption date past the date of the sheriff's sale. Your particular state may be different. You need to consult your own state laws on that issue. Then typically there's a foreclosure sale. In my county, that's governed by the sheriff. So once the bank receives a judgment, they take the judgment to the sheriff's office, and then the local sheriff's office actually facilitates the sheriff's sale. So some of the consequences of foreclosure sale. Like I just mentioned, it cuts off the right to cure. So once the foreclosure sale takes place, the borrower can no longer reinstate the loan. As I indicated too, it may cut off the right to redeem. Some properties allow the borrower to redeem even 10, 20 days after the sheriff's sale. My state is not like that, but you need to consult your own state law. But bottom line is, the sheriff's sale is very difficult to undo later. It also terminates the borrower's right to cancel under the Federal Truth in Lending Act, and it prevents the home from being saved through a bankruptcy filing. Then you just have to think about the different consequences of foreclosure for the different people involved. Obviously for the homeowner it can be fairly traumatic and embarrassing to have to go through a foreclosure. as a counselor, it's your job to come alongside them in that process and really be someone that can give them good sound advice and counsel to help them through a really difficult time in their life. For the mortgage holder, it may mean that they lose money. I think that there was some statistic recently that the average foreclosure actually loses $25,000 for the owner of the mortgage. So it's an expensive thing for the bank to lose the home as well. They'd much rather have the borrower's payments come in. For the neighborhood and the community, obviously it can cause blight, reduction in property values. If the property becomes abandoned and not taken care of, it can attract crime. So foreclosure is a very, very negative thing. And then we saw, for the entire country, how the foreclosure crisis in the last several years really accelerated some of the other negative things that were going on in the economy. So it's a really, really bad thing. It's it's a great job for you to help your local community and help homeowners in your area to keep their homes. It's good for everyone involved. So some tips for counselors about the foreclosure process. Make sure you understand your individual state's foreclosure process. I can't state that enough. I mean, every state is going to be very, very different. The reason that's important is because your client's going to have a million questions about it. They're going to want to know how much time they have left in the home, what they can expect, in terms of the process. Without giving legal advice, you can give them information about some of the timelines involved. You're going to want to know your client's foreclosure sale date, if there is one. That can be very important for, notating if you're submitting something for hardest-hit funding, or if you're putting an application in the lender. Sometimes they want to know what the sale date is if it's not in their system, so that they can kind of triage. You can triage your clients, they can triage the applications they're getting to get those people the quickest service. If you get any extensions of time, whether it's to submit documents or anything like that, you always want to try and get it in writing. It's never good to just have someone tell you something on the phone and then you rely on that. Another tip, really build those relationships with your local foreclosure law firms. It doesn't have to be, an adversarial relationship. If you're partnering with those firms, like one thing that we do is we compile a list of contacts at all the different foreclosure law firms where we can directly send loss mitigation paperwork, which can be very helpful, so that we can send it through this centralized email, PDF format, traceable. Sometimes faxes can be unreliable, so really use your local law firms as a resource. So for activity 1.1, you're going to identify your your individual state's foreclosure law. The different state summaries are found on pages 11 through 46, and then you're going to, on your own, answer some questions on page 7, which is activity 1.1. Some resources on Blackboard for you. There's some appendix documents in there, a glossary, and then there's a specialized glossary of mortgage servicing terms in there as well for you. And that is the end of section 1.1.